Hi, I'm Duncan. I'm the CEO of TAB and very excited to be launching the TAB University podcast.
Hi, I'm Ellie Corman. I'm Chief Investment Officer of TAB and also Head of Development Finance, but we're not going to get into much about development finance at the moment.
And as mentioned, I'm Katrina and I'm the Head of Marketing. And this is our podcast. Question number 1, Duncan, what is property investment to you?
Property investment to me in simple terms is buying a property and then deciding what you want to do with it long term, either renting it and earning an income or adding value and potentially selling it on.
And Ellie?
Pretty much the same thing. It's about taking equity that I've got available, making a choice to invest in property, which is bricks and mortar, rather than bonds and shares and other similar asset classes.
Cool. And, it's quite a broad subject. And what kinds of property investment can you do? Let's say I've got 50 grand. What opportunities do I have in the property investment world?
Yeah, so I think it's really important to have a plan, obviously. There are lots of different properties that will be excluded from that, what sounds like a really large sum of money, £50,000, but actually in reality when it comes to buying a property can seem pretty small. Most ways that people buy property is with a mortgage, pretty much the only way apart from buying it with your own cash. So if you think the way that mortgages work, typically you can borrow a percentage of the value of a property. If a property was 250,000 and you had to borrow and you were able to borrow 80% of that, the 50,000 that you've got would all be used up as your deposit. And then on top of that, you've got other things to consider like stamp duty, which is a tax. You have legal fees, you have all sorts of other sort of added costs, which we can talk about more as we go on. As far as what types of properties can you buy?
Yeah, let me add a little bit of colour on the types of properties. There's lots of things available. You can buy residential, you can buy commercial. Commercial can include retail. It can include office space. We think of office space as big buildings in the centre of London. It doesn't have to be. There's lots of little offices around that you can invest in and you can purchase those. It doesn't have to be residential. There's different types of terms of the properties. You can buy freehold, you can buy leasehold. There's lots of things you can look at, and really the best way to sort of try to get your head around this is to just take a look on some of the property portals such as Rightmove or Zoopla and just see what takes your fancy, what you're looking for. Location is really important. We all talk about location for buying your own home, but location is really important when it comes to investment as well.
Yeah, and I think also you touched on leasehold and freehold. That's also very important consideration when you think about the ongoing costs. I think if you own a leasehold property, you're not always allowed to do everything that you might want to do without the freeholder's permission. So
can we give a little definition on leasehold and freehold?
Yeah, absolutely. So freehold is effectively, if you can imagine a house, a 3-bedroom house you may own in whatever the location is. The freehold means you own the building and the land with it. As opposed to freehold is typically as opposed to leasehold, which is typically in a block of flats where, let's say there's 5 flats in that one building. You don't own the land necessarily. The freeholder retains the ownership of the land, and you lease the space within that land called your flat. And typically properties in the UK are leased for 125 years. Some more high-end properties are leased for 250 years, or even when it comes to retail, it's leased for 999 years.
Yeah, it is a minefield, and just to reiterate some of what Ellie said, freehold means, in my view, in the simplest possible terms, you own the land forever, and leasehold means that you're renting the property on top of the land for a prolonged period of time.
And are these things to be concerned with when you're, let's say, getting into your first property investment?
I wouldn't say concerned, I would say considered. These aren't new things. There's nothing to be scared of in terms of buying a leasehold property. You should take legal advice on various elements of that. So if the lease has only got 50 years remaining, that's not a great position to be in. You have to consider that in 50 years' time for you, your children, that's going to potentially go back to the freeholder, because as Duncan said, the freeholder owns the land, and you as a leaseholder, you're effectively renting it off him for 125 years. So if there's only 50 or 30 years left, that's something to be wary of. But on the flip side, if it's got 100 years left, that's more than ample. And again, that comes through a little bit of legal advice and just researching the impacts of leasehold property.
Yeah, and as far as it being an investment, as far as property being an investment is concerned, there are additional costs of being a leaseholder. I mean, the most obvious one, as Ellie just described, if you've got 50 years left on the lease and you want to retain ownership of that property for longer than 50 years, then there'll typically be a lease extension. I agree that hell of a lot of research is needed here, and your solicitor or lawyer should be able to advise you, but just because these things are changing so quickly. But in order to extend your lease from 50 years to 100 years, you would have to pay the freeholder again. And there's a calculation, a quite complicated calculation that says, if I want to extend my lease. And the other thing just to add is that when you're a leaseholder, you do pay an annual rent to the freeholder. And that has changed and is changing quite dramatically. It used to be described as a peppercorn rent, meaning just £1 or £2 to kind of evidence that you are paying your rent as a leaseholder. But over the last maybe 25 years, things got much more complicated, and ground rent, which is what it's called, has risen from a small peppercorn rent to sometimes £250 or even £500 a year. And then during the course of your lease, that can increase, I think typically doubles every 10 years sometimes. So you think that in 30 years you could be paying £1,000 a year. And I think that's what the government has tried to really crack down on, as far as freeholders taking advantage of the fact that there are these long leases in place.
Absolutely.
Cool. Let's go on to question number 2, which is how to invest in property. So let's start with the basics. As I said, I've got 50 grand. What's the first thing I should do to get into property?
First thing has to be location. You have to pick an area that you want to invest in. It doesn't have to be an area you live in. It can be further out. We're sitting here in London. London can be quite unaffordable with £50,000 to do property investments. It doesn't have to be in London. You can go further afield. You can look at things in Manchester, Birmingham, other good city centres. They don't have to be great city centres. They can be sort of countryside properties as well. You have to find the location that suits you. It excites you. It's an area that you want to be involved with. When we invest, we're not necessarily looking for short-term investments for a year. We could be generally with property looking for 10-year, even 20-year investments. So you have to be happy with the location. So a lot of research around the location is important.
And Duncan?
Yeah, I mean, location for sure. I guess the one thing I would say right at the outset is, how long are you investing for? So is this a short-term or a long-term investment? And I think that will dictate the type of property that you buy. So obviously a longer-term investment in my mind means that I'm buying a property to rent it out, whether it's commercial or residential. I'm expecting that pretty soon after I complete this property purchase, I'm going to rent it and therefore receive an income. And alternatively, if your plan is to buy something and add value and then sell the property, it's another way, I think, to invest in property. And that you may be looking for slightly different things, but absolutely you'd be focused on location.
Yeah, and what about auctions? I've heard about these auction places where I can buy a house or whatever, but what does that really mean?
I mean, auction is basically a way of buying property quickly. So one of the things that makes property investment quite difficult is it is a long, drawn-out process. You can go and see a property you like and you can make offers, but the way the legal system works in this country, until you've exchanged to buy that property, neither side is actually committed. So there's a lot of, you've heard terms like gazumping going on, where people think they've agreed to buy something and it turns out they actually haven't agreed to buy it, and that can all add cost and time to a transaction. So auction is a way where you used to sit in a room full of people, a property would come up, everyone in the room would have a chance to bid, say 500,000, 510, 520, and if the hammer goes down on your bid, you have effectively exchanged to buy that property straight away. So it is a way for sellers to sell stuff quickly, and after that exchange period, you've typically got 4 or 6 weeks to complete, but it's also a way for buyers to go, and I think there's a perception that you can get a good deal at the auctions, because obviously you've only got that room either virtual or physical, to aim at. But actually, I think what's happened is that the auctions have become very competitive with not just property investors, but also end users who want to find a property that's got some value.
Yeah, I absolutely agree. Auction houses used to be a place where people went to get deals. Now it's just a great normal piece of marketplace to go and buy property, much like you look at Rightmove or Zoopla or other websites like that, or going to your local estate agents. But all these things, again, it comes back to location. Once you've picked a location you want to buy and an asset class you want to buy, whether it be residential or retail, freehold, leasehold, whatever it may be, you can then look on in those areas on Rightmove, Zoopla, or in the auction catalogues, and start to hone down into what you're looking for. And obviously, don't rush any property purchase. Look into it and get comfortable with the property, get comfortable with the areas. And once you've done that, then you know it's I would say it's fairly easy after that.
Yeah, it's become a bit more complicated. You have to register beforehand and make sure. I think it's become more mainstream, whereas typically in the past it would have been full of investors who knew what they were doing.
And, what other ways can we start with investing in property? What kind of other options are there about? Let's say if me and a friend wanted to go together, is that something we can do? Is it?
Yeah, I think I'm going to bring it back to Tab for a minute, because I've been involved in these sort of questions for a long time, and there haven't been that many ways to access a property as an investment before. There is, Ellie mentioned the stock market. Theoretically, there are some listed property firms that are on the stock market, meaning that you can invest directly into a few property companies who trade on the stock exchange and have a price at any time, and a market where you can buy in and sell. I don't think that's typically that aligned to people that want to invest in property. What Tab is doing, two things that Tab does that gives people the opportunity to invest in property. One is our lending product, which has always existed, and although you're then investing into a loan, you still have security of real estate or assets in the UK sitting behind each loan. Those loans pay you a monthly return, and they are secured against property, but you're not actually buying the property, and you don't have the kind of eventual upside or potential downside of owning that property. But theoretically, a lower risk, because we only lend against 60 or 70% of that property's valuation. So that is one way to access property, I guess. But then taking that to the next step, what we've built now is the ability for investors to purchase a small piece of a property, what's described as fractional ownership, and that means that we can take a property, let's say £500,000, we make it available to the wider market or any Tab customers, and if you wanted to put your £50,000 into that property, you would be buying 10% of that property. And what Tab does, in a similar way to what we do with loans, is we will manage that investment on your behalf. We will rent the property, collect all of the rent, and then pay everybody their share at the end of every month. So it's quite a well-trodden path now. You can invest in almost every asset class, bar property, properly up until this point with small amounts of money. So you can invest in wine, art, gold, cars, and all over the UK and the US and the Middle East. These sort of fractional ownership businesses are popping up, but I certainly think that this is a way for people to invest much smaller amounts, so you wouldn't have to put all of your 50,000 into one property investment. You could invest, say, 10,000 across 5 different properties and build up a portfolio of property. As far as the legal documentation is concerned, you do actually have ownership rights over that property, but you don't have to go through the same hoops to jump through, and also you don't have to get a mortgage and leverage yourself with personal debt to do so.
Yeah, historically, property has always been an expensive asset class, so it's actually quite difficult to get into, and always you're looking at the top echelons of UK wealth who can buy into that. Well, what we're trying to do is try and make that affordable for everybody. So, like you said, not everyone has got £50,000 they can invest in property, and with £50,000, what property can you necessarily buy? And to go down the mortgage route, you have to have good credit ratings, whereas buying fractional ownership, like you can do with many other asset classes, gives everybody the opportunity to buy into property and make a return on that property, but also something we haven't discussed is the capital growth behind that.
Sure.
People who bought properties 20 years ago have made a lot of equity from the capital growth of that property. those
Absolutely.
that can't buy into that have lost that opportunity, whereas TAB's fractional ownership has given people the opportunity for growth over a period of 5 to 10 years as well.
Yeah, and I think that's why property investment has always been seen to be something that people aspire to do, because you get a monthly income and potential capital growth. And as I said right at the outset, over most 10-year periods in history, property has gone up a lot. I think every 20 years property doubles pretty much, and you have this regular income and you also have capital appreciation. Obviously property can go down in value, and when I talked earlier about having this, whether it's a short-term or long-term investment, within those 20 years that I just described, where property typically doubles, you might have a 5-year period where property doesn't move very much or property can go down. So these things are often about timing, and I just feel that the only way to buy property shouldn't be saddling yourself with a lot of debt. So take your 50,000, borrow 250,000 from the bank, and then that money you personally owe to the bank for 25 years or more. And if your tenant doesn't pay you, you're still obligated to pay your mortgage. So you can end up with aspiring to own an asset but actually having a liability.
So I guess that brings us nicely on to question number 3, which is property a good investment? We've kind of mentioned you can buy property and take on a load of debt, but then you've also got the other end of the spectrum where you can just apportion a little bit of your cash to a little bit of a property. I guess a lot of it probably does depend on your investment goals, but overall, I guess, would you say, Ellie, is property a good investment?
Yeah, personally, I would say property is a good investment. The way one can view things is, if you're investing in shares, whether it be, let's say RBS shares or Tesco shares, you're very much exposed to the performance of that corporate in the marketplace, and then your shares will either rise or fall based on their performance. Property is back to bricks and mortar. Yes, property prices can fall, but at the end of the day, people need places to live. For years and years and years, this country has never produced enough property year on year to support the demand of more homes and housing. So the bricks and mortar value is very valuable, and something that generally does increase. Despite the fact that you can have little bits of peaks and troughs through time, it is a fairly solid, fairly safe investment. But again, that depends on your leverage as well, which is important. What Duncan was coming to, if you're spending £50,000 of your equity and leveraging that with £250,000 of mortgage, that becomes a liability. So back to something you were saying earlier about friends and family, sometimes it's worthwhile splitting your investment with a friend or a family. So you're sharing your returns, but you're also sharing your risk.
Back to fractional ownership. I definitely think property is a good investment. I think the key thing people need to remember is there aren't many get-rich-quick schemes, and property investment certainly shouldn't be seen to be, can I double my money if I buy this property and I do it up and I sell it back in an auction? I'm going to turn my 50,000 into 100,000. I think when people are searching on the internet for is this a good investment, what they're not considering is how long is it going to take to come good, and are there going to be kind of peaks and troughs along the way? And just reverting back to this having a mortgage situation, mortgage rates can fluctuate and do fluctuate, and it's very difficult to project what your income's going to be for the next 5, 10, 15 years. You can have a good idea of how the capital growth is going to work. It can be different areas, as Ellie said, will obviously perform better if there's new infrastructure coming into an area. You can understand that this kind of rundown area in 25 years might look very different, but understanding the cost of the debt and how that property is going to perform during that time is incredibly complex, and trying to work out what your return on investment is can be complex, because you have months where the property's empty, you might have to refurbish the property again in 5 years' time. So understanding how well your capital works for you, I think, can be complicated. But
yeah, I mean, look, we paint a rosy picture about property investment being a great thing to do. I think it's something people understand better because we all live in homes, so we can understand it. But something we've not touched on is obviously the cost elements of that.
Sure.
You can own a flat, you can move in within 1 week, you can have a leak, and that's a cost that you weren't expecting. So there's always these extra costs you need to think about, and you need to analyse what you're looking for, back to sort of, is property a good investment? You have to analyse what you're looking for in terms of return of your money. Well, you're looking for short-term gain, long-term gain, and all these things need to be taken into account when making an investment decision.
Cool. Let's move on to question number 4. I think we probably already touched on it a little bit, but how to invest in property with little money.
Difficult. Historically very difficult. I think there's a couple of ways I would think this through. One is that, as Ellie said earlier, buying property in London's extremely difficult. If you go up north and further up north, you can buy a family home for under £100,000, meaning that if you need to put 20% in, that's obviously much closer to 20,000 than it would be 50,000 to buy an equivalent property. Even not as far south as London, even kind of Manchester and Liverpool and Birmingham, talking about 250,000, 300,000 for a small flat. So one way that you can invest with a small amount of money is to look further afield, and that's not necessarily a bad thing. There are still growth areas up north and areas to consider. I think looking for value, so one of the ways that bridging finance works in this scenario is if you can legitimately negotiate a purchase of, let's say, a £200,000 property for £150,000, there's the potential from bridging loans and all sorts of different loans out there that you can borrow against its true value, meaning that your 50,000 deposit might be, much smaller because the bank's lending you more against what they believe the value is. But that's less and less common, and certainly from a tab perspective, we're going to be inviting people to buy into property investments from something like £1,000. So obviously you're only buying a very tiny percentage of that property, but you are getting yourself, in my view, on the property ladder and starting to build a portfolio, one small step at a time.
Or a tab.
Yeah, absolutely. Yeah, it's sort of pretty much what Duncan was saying is it's very difficult to buy property with small amounts of money. You touched on it before about friends and family. You can join together and try and buy something. Further north is obviously a little bit cheaper, but that's the
borrowing is basically the answer. If you don't have the money yourself, you need to borrow it, and then obviously that comes with constraints, but it is possible to borrow money, and typically you'll find that when you're trying to borrow money secured against a property, it's a lot easier than borrowing money to buy a car or go out for a night or whatever it may be. So it can be a relatively sensible way. If you go through the things we've talked about before and you find a growth area, you find a property that's undervalued, you have a plan for how you're going to turn it around quickly and get it rented and get a good income, then you should be able to borrow a lot of that money, but it's something that you need to consider because you can wipe yourself out in one go.
Yeah, we don't want that.
No.
So these kind of been our top questions that were asked on Google, and the final one that myself took a long time to get around because there's a couple of things. But question number 5: what does yield mean in property investment?
So I see there's 2 ways to look at the yield. Effective yield is your return on your investment. That's the bottom line in a nutshell. But there's 2 ways to consider it. You can either view it as a cash on cash return. So if I'm buying a property for, let's say, £500,000 and I'm putting in £50,000 of that, and the property is producing £10,000 net a year, then your return can be £10,000 on the £50,000, or you can view it as £10,000 on the £500,000. So there's 2 ways to view it. Generally, from a property perspective, I'm looking to see how hard I can work my money, how hard I can work my cash. There's other things I can do with that cash. So I'm always looking to see what is my return on my equity investment.
Yeah, it is a difficult one to answer, but I think the best way I can describe it off the top of my head, maybe I should have prepared a little better on this one, is exactly as Ellie said. Basically, if you're investing in property, you want to understand why you're investing in property and what your alternatives are. So the yield is exactly as Ellie described. It is how much of a return am I going to get on the amount of money that I'm putting in. So I hear your 2 options. For me, I'm very focused on what the return is on my capital. That does change somewhat when you're able to buy a much bigger asset because you're borrowing some of that money, so you can calculate your yield differently. But if we keep it simple and say, I've got £50,000, Tab's offering me 5%, which is £2,500 a year. So the yield would be the amount per year that I'm going to receive, and then it's typically represented as a percentage. So if I put in £50,000 and I get £5,000 a year, that would be a 10% yield. So 10% of the amount that I've put in, I'm getting back every year. And obviously, if I only got 2.5%, 2,500 off my 50,000, that would be a 5% return. And then you can start to compare against what do I get putting my money in the bank. Obviously, there's a completely different risk profile. 85,000 or more of your money is protected at the bank, meaning that if the bank goes bust, the government guarantees to give you your money back. I'm not suggesting that I'm comparing the two different types of investment from a risk profile, but what you can look at is, would I take more risk to get 5% when the bank's paying me less than 1% per annum? So on my 50,000 investment in the bank, I'm only getting £500 a year. And if I put my money into a 10% investment, I might be getting £5,000 a year. And I think that should be considered along with the associated risks.
Yeah, and part of that risk that needs to be considered is often a lot of what people do is they look at gross return.
Yeah.
And gross return doesn't really give you any actual real metric of your return, because you have to take into account the costs that come into that. There's a mortgage costs, there are void periods when you have tenancies. You have to always reserve a little bit for repairs. So you always have to look at the net return. So as Duncan said, when you're talking about £5,000, that needs to be a net £5,000 after all costs taken into consideration.
Yeah, absolutely. If you put in 50,000 and you're getting 5,000 a year in rent, that would be your gross return. If you're then paying £2,000 in mortgage costs and agency fees, your net return is only 3,000, and that's probably a better cost, it's probably a better yield to be focused on. And again, you can start to use this yield calculation and compare it to, if I invest in the stock market, people think that these shares are going to grow. Take Apple as a random example, might grow 5% a year. Obviously, it's had years where it's grown much more than that. But you would then look at the complexities in investing your money into the stock market versus buying a property or putting your money in the bank. So it's just a way to calculate how hard your money is working for you. That
Cool.
make sense?
Yeah.
Yeah, and just one small point to remember, at the end of that with property is always the capital growth element of that. You can't calculate that into your net returns because you don't know what that's going to be. To me, that's always just the cherry on the cake at the end of the investment term.
Yeah, or when you sell it, and then you want to calculate how much my overall return was, what my, then you can add that back in, but you certainly shouldn't be sort of
relying on that from the start.
Yeah, it's not going to provide you an income
Yeah.
in the same way.